Dividend histories can be comforting. They whisper reliability, promise income, and often signal confidence. For years, Shakey's Pizza Asia Ventures Inc. seemed to offer just that, a familiar consumer brand, growing outlets, and dividends that, after stumbling during the pandemic, have held strong at 0.20 pesos per share since 2024. But in the current landscape, expecting another dividend increase may be wishful thinking. In fact, the more sobering reality is that the next move could be to simply hold the line or pause distributions altogether. The reason comes down to priorities. Shakey's faces a looming obligation, a BDO bank loan with a remaining balance of 3.55 billion pesos, falling due in June 2026. Reclassified as a current liability, it stands front and center on the balance sheet, a bill that must be settled, whether through cash payment or refinancing. Management is negotiating for an extension, but until terms are finalized, the obligation is unavoidable. This debt takes precedence. While paying dividends is a choice, servicing debt is not. Every peso distributed reduces the cushion that reassures creditors and supports refinancing. Given these constraints, a larger dividend simply doesn't fit with prudent management. Recent performance underscores the caution. Yes, system-wide sales in the first quarter grew 14%, but profitability told a different story. Net income fell 27%, margins thinned, and investment in new stores absorbed capital. Cash flow from operations grew, but much of it was reinvested back into the business, leaving only a slim margin for payouts before considering the annual 337 million pesos dividend bill. Balance sheet metrics are firm, but not generous. Net debt stands at 5 billion pesos, with a net debt-to-equity ratio of 1.1 times, manageable for a growth story, but significant enough to justify a defensive stance until refinancing is secured. The current ratio, at just 0.6 times, highlights the pressure from near-term obligations. The optics are clear. Raising dividends now might jeopardize critical negotiations. Holding steady looks reasonable. A temporary pause, while not expected, would be strategically defensible if liquidity needs intensify. Importantly, Shakey's core business remains strong. Franchise growth, brand loyalty, and innovation continue to deliver expansion. But there's a difference between a company positioned for long-term growth and one able to raise payouts right now. The lesson is straightforward. Dividend history provides comfort, but it cannot be viewed in isolation. With refinancing pending and heavy capital needs, prudent management puts liquidity first. For shareholders hoping for a richer slice, patience may be necessary. Creditors, at least for now, are first in line.